January 20th, 2025. A single trading candle in Tokyo just triggered what analysts are calling the opening salvo of the largest debt crisis in modern history. Japan's 30-year bond yield surged 8.61% in one day. Silver didn't just rise, it shattered through $95. Gold breached $2,740. But here's what Wall Street isn't telling you. Japan holds $1.12 trillion of America's debt, and they may be forced to sell. What happens next could determine whether your savings survive or vanish. The clock is ticking. Welcome to Cash Tale, where we decode the financial earthquakes before they shake your foundation. If you've been with us before, you understand the value of being prepared. If you're new here, this might be the most important channel subscription you make this year. We don't chase headlines. We analyze the structural cracks in the global system. Do us a favor. Hit that subscribe button. Think of it as securing your seat at the table where serious economic discussions happen. We'd also love to know, where in the world are you watching this from? Drop your location in the comments below. Let's see how global this community really is. Now, let's get into what's actually happening. On January 20th, 2025, financial markets transmitted a signal that seasoned analysts had been dreading for years. It wasn't a dramatic stock market crash. It wasn't a bank failure announcement. It was something far more insidious. A tremor in the foundation of the global debt structure itself. The Japanese 30-year Treasury yield spiked 8.61% in a single trading session. For those unfamiliar with bond market mechanics, this movement represents an extraordinary dislocation. In developed economies with stable monetary systems, bond yields simply don't move this violently. This is the type of volatility typically reserved for frontier markets, for economies on the brink of sovereign default, for nations whose central banks have lost all credibility. Yet here it was, playing out in the world's third largest economy. Silver's response was immediate and unambiguous. The precious metal didn't just edge higher, it surged past $95 per ounce, carving out a new all-time high in dollar terms. Earlier in the session, it had briefly touched $95.86 before settling back. Gold followed suit, breaking through $2,640 and establishing its own record territory. These weren't modest gains. These were breakout moves that confirmed a fundamental shift in market psychology. The technical picture told a compelling story. While silver climbed 4.38%, gold advanced 3.24%. The gold-to-silver ratio, a metric closely watched by precious metals analysts, briefly dipped below 50 to 1. This compression in the ratio typically signals that silver is beginning to outperform gold, a characteristic pattern during the acceleration phase of precious metals bull markets. But the movement wasn't confined to just gold and silver. The entire precious metals complex was activating. Platinum surged nearly 5%, threatening to break out of a prolonged consolidation pattern. Palladium tested critical resistance levels. The unified movement across all four major precious metals indicated something beyond routine profit-taking or speculative positioning. This was institutional capital seeking protection. The mining sector provided additional confirmation. The GDX, an exchange-traded fund tracking senior gold mining companies, gapped upward at the open and closed more than 5% higher. The SILJ, which tracks junior silver miners, posted similar gains exceeding 4.6%. When mining equities confirm moves in the underlying metals, it signals that sophisticated investors view the rally as sustainable rather than ephemeral. Meanwhile, Bitcoin told a different story entirely. The cryptocurrency that had been marketed as digital gold and a hedge against fiat currency debasement was trading below $90,000, down substantially from recent highs. The divergence was striking. Traditional safe haven assets were surging while the digital alternative faltered. The narrative around uncorrelated assets and alternative stores of value was being tested in real time, and the results were unambiguous. To understand why January 20th matters, one must first understand Japan's unique position in the global financial architecture. This is not simply another developed economy. Japan carries the highest debt-to-GDP ratio of any major nation, exceeding 264%. For context, this means Japan's government debt is more than 2.5 times the size of its entire annual economic output. Under normal circumstances, such debt levels would trigger capital flight and currency collapse. But Japan has maintained stability through a combination of domestic savings, central bank intervention, and its strategic role as the largest foreign holder of U.S. Treasury securities. That last point deserves emphasis. Japan holds approximately $1.12 trillion in American government debt. This isn't merely an investment position, it's a geopolitical anchor. Japan recycles its trade surpluses and savings into U.S. Treasuries, helping to finance American deficit spending while maintaining the dollar-yen exchange rate within acceptable bands. This arrangement has functioned for decades. It has survived multiple crises. It has weathered political transitions and economic shocks. But when a 30-year Japanese government bond yield spikes 8.61% in a single day, it signals that this arrangement is under severe stress. The comparison to emerging market volatility isn't hyperbolic. Bond yields in stable developed economies don't behave this way. When they do, it indicates that investors are demanding substantially higher compensation for the risk of holding that government's debt. It means confidence is eroding. It means the market is repricing risk. And when the market reprices risk in the world's most indebted developed economy, the one holding over $1 trillion of another nation's debt, the implications cascade outward. The question facing analysts wasn't whether this mattered. The question was how quickly the contagion would spread and how severe the response would need to be. Silver's breach of $95 was merely the opening chapter. The mechanics of what unfolded on January 20th require understanding a system most investors never examine closely: the inverse relationship between bond prices and yields. When confidence in a government's ability to service its debt erodes, investors sell those bonds. As bonds flood the market, their prices fall, and as prices fall, the yield, the effective interest rate, must rise to attract new buyers. It's a mathematical certainty, not a theory. Japan's 8.61% yield spike in a single session meant that investors were dumping Japanese government bonds at a pace rarely witnessed in developed markets. They weren't waiting for tomorrow. They weren't hedging gradually. They were exiting positions immediately. The catalyst was clear enough. Inflation in Japan has been rising steadily, eroding the real value of yen-denominated bonds. For decades, Japan struggled with deflation, a problem most central banks would envy in retrospect. But aggressive monetary stimulus finally achieved its goal. Prices began rising. Now the Japanese central bank faces a dilemma with no clean solution. Traditionally, when bond yields spike and threaten financial stability, central banks intervene. They purchase government bonds using newly created currency, driving yields back down. This is quantitative easing, the primary tool in the modern central banker's arsenal, but Japan has already deployed this weapon extensively. The Bank of Japan's balance sheet is bloated with government debt accumulated over years of stimulus programs. Further expansion risks accelerating the very inflation that's driving investors away from Japanese bonds in the first place. The central bank cannot credibly promise to contain inflation, while simultaneously printing massive quantities of new yen to suppress bond yields. The contradiction is too obvious. Markets would see through it immediately. So Japan confronts a different calculus entirely. If the Bank of Japan won't print yen to defend bond yields, where does the liquidity come from? One option remains readily available: liquidating foreign assets. Specifically, selling the $1.12 trillion stockpile of U.S. Treasury securities. This is where the crisis transmission mechanism becomes clear. If Japan begins offloading U.S. Treasuries to raise dollars, those bonds enter the American market, supply increases. And unless demand rises proportionally, U.S. Treasury yields must climb to attract buyers. On January 20th, U.S. bond yields were already moving higher. The 10-year Treasury yield jumped 1.09%. The 30-year yield gapped upward at the market open, rising 1.24%. These weren't catastrophic moves yet, but they represented the initial tremors of a potentially larger shift. The problem compounds when examining America's own debt dynamics. The U.S. national debt now exceeds $36.2 trillion. The annual cost of servicing this debt, simply paying the interest, has surpassed $1 trillion. This figure is not static. Every time Treasury yields rise, the government's borrowing costs increase when existing debt is rolled over. America issues new debt constantly. Old bonds mature and must be replaced with new ones. If those new bonds carry higher yields, the debt service burden grows automatically. It's a treadmill that accelerates with each step. President Trump understood this dynamic acutely. Throughout late 2024, he publicly pressured the Federal Reserve to cut interest rates more aggressively, arguing that elevated borrowing costs were unsustainable given the debt load. The Fed, facing its own inflation concerns, resisted these calls initially. Then, in December 2024, the Federal Reserve quietly announced the resumption of Treasury purchases. They framed it carefully, not as quantitative easing, merely as a technical adjustment to manage short-term interest rates. But the mechanism was identical. The Fed was once again expanding its balance sheet by purchasing government debt with created currency. The timing was telling. There was no immediate crisis forcing this action. Markets were functioning. Credit was flowing. Yet the Fed preemptively resumed bond purchases anyway. They saw what was coming. The historical pattern is instructive. In 2008, the financial crisis forced the Fed to begin large-scale asset purchases. The balance sheet expanded from under $900 billion to over $4 trillion by 2015. They attempted to normalize, to sell assets, and shrink the balance sheet, beginning in 2018. By September 2019, stress appeared in overnight lending markets. The Fed reversed course, resuming purchases. Then the 20-day 20 health crisis provided justification for an unprecedented expansion. The balance sheet surged from $4 trillion to nearly $9 trillion by mid-2022. Inflation spiked. The Fed attempted quantitative tightening again. By March 2023, regional banks were failing. Silicon Valley Bank, Signature Bank, First Republic. The Fed intervened with emergency lending facilities. Another expansion disguised under different terminology. The pattern is unmistakable. Each attempt to normalize the balance sheet fails. Each crisis requires a larger response. The addiction to monetary stimulus deepens with every cycle. And now, facing Japanese bond market dislocations and potential Treasury selling by the world's largest foreign holder, the Fed finds itself with even less room to maneuver than in previous episodes. The currency debasement isn't hypothetical, it's mechanical. If Japan sells treasuries and the Fed must absorb them, new dollars enter circulation. The money supply expands. The purchasing power of each existing dollar declines proportionally. Silver above $95 wasn't speculation. It was recognition of mathematical inevitability. Every major financial crisis since the Bretton Woods collapse has followed a predictable script. Markets convulse, governments panic, central banks coordinate. The coordination is what matters most. In September 2008, as Lehman Brothers imploded and credit markets froze, central banks across the developed world didn't just act, they acted in unison. The Federal Reserve established currency swap lines with the European Central Bank, the Bank of England, the Bank of Japan, and the Swiss National Bank. These swap lines allowed foreign central banks to access dollars directly from the Fed, preventing a catastrophic dollar shortage in international markets. The coordination extended beyond emergency lending. Interest rate cuts were announced simultaneously across multiple jurisdictions. Quantitative easing programs were launched in parallel. The message was clear and deliberate. The world's major economic powers stood together against systemic collapse. March 2020 followed an identical template. As pandemic lockdowns triggered market panic, central banks reactivated swap lines within days. The Fed expanded them to 14 foreign central banks. Trillions in coordinated stimulus flooded the global financial system. The speed and scale of the response was unprecedented, but the framework was familiar. Cooperation, unity, synchronized intervention. This coordination wasn't charity or idealism. It was pragmatic recognition of an uncomfortable truth. The modern fiat currency system is a web of interconnected liabilities. When one major node fails, the contagion spreads rapidly through established financial channels. No major economy can insulate itself completely. Japan's holdings of U.S. treasuries aren't an isolated investment position. They're part of a complex structure where American deficit spending is financed by foreign capital recycling, which itself depends on trade relationships, currency stability, and geopolitical alignment. Break one link, and the entire chain becomes unstable. But January 2025 presents a fundamentally different landscape. The political cohesion that enabled previous coordinated responses has fractured badly. On January 19th, just one day before Japanese bond yields spiked, President Trump issued public ultimatums to 7 European Union nations and the United Kingdom. The demand was explicit: support American territorial claims to Greenland or face comprehensive tariffs on exports to the United States. The territories in question weren't minor trade partners. The list included Germany, France, the UK, Belgium, Ireland, Luxembourg, and the Netherlands. Collectively, these nations represent the core of European economic power and a substantial portion of global GDP. More importantly, they represent something else entirely: the largest collective holder of U.S. financial assets outside of Japan. An analyst at Deutsche Bank quantified the leverage precisely. European countries hold approximately $8 trillion in combined U.S. bonds and equities. This figure is nearly double what the rest of the world holds combined. It represents decades of accumulated capital flows, trade surpluses recycled into dollar-denominated assets, and central bank reserve management. George Sarvelos, head of foreign exchange research at Deutsche Bank, articulated the strategic implication bluntly. In an environment where the geo-economic stability of the Western alliance faces existential disruption, European willingness to continue financing American deficits cannot be assumed. The threat isn't that Europe would weaponize this $8 trillion stockpile by dumping it overnight. Such an action would be economically suicidal. It would crash the value of their own holdings and destabilize their export markets simultaneously. It's the financial equivalent of a nuclear option, devastating to both parties. But the threat doesn't require full deployment to be effective. What if European central banks and institutional investors simply slowed their purchases of new U.S. Treasury issuance? Not a reversal, just a reduction in appetite. What if they allocated a slightly higher percentage of reserves to gold, to euros, to infrastructure investments within Europe itself? The effect on U.S. borrowing costs would be immediate and substantial. Treasury auctions depend on consistent foreign demand to absorb the volume of new debt issued weekly. The U.S. government doesn't fund itself exclusively through domestic savings. It relies on the global capital recycling mechanism. When major participants reduce their bid, Yields must rise to attract marginal buyers. The data from the Treasury Department's official records confirmed the concentration risk. Japan held $1.12 trillion. The UK held the second largest position. Canada, Belgium, Luxembourg, France, Ireland, Switzerland, Norway, and Germany all appeared in the top foreign holder rankings. $8 trillion in European hands, over $1 trillion in Japanese hands. These weren't diversified holdings spread across hundreds of small nations. The concentration was acute, and the geopolitical alignment that had previously guaranteed their continued participation was now openly questioned. President Trump's tariff threats over Greenland might have seemed theatrical to casual observers. But to bond market strategists and central bank governors, the message was unmistakable. The implicit security guarantees and diplomatic cooperation that undergirded decades of financial arrangements were now transactional, subject to negotiation, pressure, and potential withdrawal. The Europeans couldn't fight back with military force. They couldn't impose meaningful economic sanctions on the world's largest economy without suffering disproportionate damage themselves. But they could withdraw from Treasury auctions. They could diversify reserve holdings. They could signal through bond markets rather than through diplomatic channels. And if they did, if foreign demand for U.S. debt faltered even modestly while Japan simultaneously faced pressure to liquidate its own Treasury holdings, the Federal Reserve would be forced into an intervention far more aggressive than anything attempted in 2008 or 2020. The difference this time was the absence of coordinated support. The Fed would be acting alone, printing dollars to absorb supply that foreign allies were no longer willing to finance. Silver's surge past $95 reflected this calculation precisely. Investors weren't betting on inflation from economic growth. They were positioning for inflation from political fragmentation, from the breakdown of the cooperative mechanisms that had previously contained debt crises. The script had changed, and nobody knew how this version would end. The mining sector's response on January 20th provided perhaps the most reliable confirmation that institutional capital was repositioning for a sustained precious metals rally rather than a fleeting headline-driven spike. The GDX, an exchange-traded fund-tracking senior gold mining companies, didn't merely edge higher. It gapped upward at the market open and closed the session up more than 5%. This wasn't retail enthusiasm or algorithmic momentum chasing. Mining equities trade with leverage to the underlying metal prices, but they also carry operational risks, geopolitical exposures, and capital structure considerations that make them sensitive to false breakouts. When mining stocks confirm a move in gold and silver, it signals that sophisticated investors have assessed the fundamentals and concluded the rally has legs. The SILJ, tracking junior silver miners, posted gains exceeding 4.6%. Junior miners are even more volatile than their senior counterparts. They're exploration and development companies with higher risk profiles and greater sensitivity to metal price movements. Their participation in the rally indicated that speculators were willing to accept elevated risk for leveraged exposure to silver's upside potential. This wasn't caution. This was conviction. From a technical analysis perspective, silver's chart structure was textbook. The metal had been carving out what traders call flag and pole formations, sharp vertical rallies followed by consolidation periods where the price moves sideways in a tight range. These consolidations digest the rapid gains, allowing new buyers to establish positions before the next leg higher. January 20th represented a breakout from one such consolidation zone. Silver gapped above resistance, established a new all-time high, and held those gains through the session. The pattern suggested another flagpole was forming, another vertical rally phase that would eventually lead to another consolidation before the next advance. Pattern recognition in markets is never certainty, but probability. And the probability framework strongly favored continuation rather than reversal. Meanwhile, traditional equity markets told a different story entirely. The S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite all closed in negative territory. The selling wasn't panic-driven, but it reflected clear risk-off sentiment. Investors were rotating out of assets dependent on economic growth and stable credit conditions, and into assets that performed during currency debasement and financial system stress. The divergence was instructive. In a normal risk-off environment, all asset classes typically decline together as investors flee to cash. But on January 20th, precious metals and mining stocks surged while equities declined. This pattern indicates a specific fear, not recession, but monetary instability. The historical precedent for wealth preservation during currency crises is extensive and well documented. During the Weimar hyperinflation of the 1920s, those holding physical gold and silver maintained purchasing power while paper currency became worthless. During the 1970s, stagflation in the United States, gold rose from $35 per ounce to over $800, while the dollar lost more than half its purchasing power. The principle is straightforward. When governments face unsustainable debt loads, they have two options: default or debase. Default is politically unacceptable and economically catastrophic. It destroys the bond market, collapses the banking system, and triggers immediate crisis. Debasement is gradual. It's politically palatable. It allows governments to pay off debt and currency worth less than when borrowed. It's the path of least resistance, and it's the path always chosen. But debasement doesn't merely mean higher nominal prices for everything. The distribution of those price increases is uneven. Assets with fixed supply appreciate faster than assets that can be produced in unlimited quantities. Hard assets outperform financial assets. Tangible goods outperform promises to pay. Gold and silver, with their geological scarcity and millennia-long track record as monetary metals, tend to outperform during these transitions, not just in nominal terms, in real purchasing power terms. A historical example illustrates this clearly. During the Great Depression of the 1930s, more millionaires were created than in any previous decade in American history. This seems paradoxical. How does a collapse in economic activity produce wealth? The answer is strategic positioning. Those who held cash and hard assets during the 1929 crash were able to purchase devalued real estate, businesses, and productive assets at generational lows. When the economy eventually recovered, their purchasing power had multiplied exponentially. The same principle applies to currency debasement cycles. Those positioned in precious metals before the debasement accelerates can convert those metals into other assets. Real estate, businesses, productive farmland, at favorable exchange ratios once those assets have declined relative to gold and silver. Timing matters enormously. Converting too early means missing the upside in metals. Converting too late means buying assets that have already repriced higher in nominal terms. The optimal strategy requires monitoring the relative valuations continuously. For now, with Japanese bond yields spiking, U.S. Treasury yields rising, political fractures preventing coordinated central bank responses, and the Federal Reserve already resuming balance sheet expansion, the setup favors continued allocation to precious metals despite record nominal prices. The risk-reward calculation isn't about whether silver at $95 is expensive in historical terms. It's about whether silver at $95 offers better protection than dollars in a bank account yielding 4%, while the money supply expands by double digits annually. It's about whether gold at $2,140 preserves wealth better than Treasury bonds yielding 4.5% when inflation runs at 6% or higher. Viewed through this framework, precious metals aren't speculative. They're defensive. They're insurance against the mathematical inevitability of currency debasement when governments cannot credibly commit to fiscal restraint. The January 20th signal wasn't subtle. Japanese bond yields surging 8.61% in one session doesn't happen in stable monetary systems. Silver breaking above $95 doesn't happen without significant capital flows seeking safety. Mining stocks gapping higher doesn't happen on rumor or speculation alone. The debt crisis that analysts have warned about for years may finally be transitioning from theoretical risk to kinetic reality. The global financial architecture built on perpetual debt expansion and coordinated central bank intervention is showing structural cracks, and those cracks are widening. Strategic positioning for what comes next isn't about market timing or short-term trading. It's about recognizing regime changes, moments when the fundamental assumptions underlying asset valuations shift permanently. January 20th, 2025 may be remembered as one such inflection point, the day when the global debt market transmitted a distress signal too clear to ignore, and when silver's breach of 95 confirmed that informed capital was already repositioning for the storm ahead. The framework is clear. The warning has been issued. What remains is execution.